Do you know what the cash conversion cycle is? Do you find your business is profitable and yet you never have cash available? This video is for you. In this video, we will discuss the cash conversion cycle. We start by considering the income statement and balance sheet discussed previously in video number 24. We need to understand the relationship between our income statement numbers and the related cash flows. Similarly, we need to understand the relationship between our balance sheet numbers and the related cash flows. We know that on day one of our business, we start with the cash raised as part of the initial investment into our organization. However, what happens to that cash as we start transacting? The first part we need to understand is how it relates to our operating activities and our net working capital, which is the current portion of our balance sheet. With that, let's dive into the presentation. Previously, in video number 24, we were introduced to the income statement. It listed our various types of income, subtracted our various expenses, and helped us calculate our profit. However, something that the income statement didn't do was clarify whether these transactions were made in exchange for cash or on credit. Income that was made on credit would only result in a cash inflow to our business once our accounts receivable settled their balances owing. Expenses incurred on credit would only result in a cash outflow from our business once we settle our accounts payable. In addition, video number 24 also introduced us to the balance sheet. It listed our various types of assets and the corresponding method of funding those assets, namely equity and liabilities. In video number 24, we were also shown how assets that were expected to be liquidated in the short term were referred to as current assets, which included cash, inventories, and accounts receivable. We also learned that liabilities that were expected to be settled in the short term were referred to as current liabilities and represented accounts payable. When we consider our operating cash flows, we note the following. Having cash implies we can pay for inventory, which is a current asset on our balance sheet, other assets, which are typically non-current assets on our balance sheet, and expenses, which are reflected on our income statement. Having inventory implies that we are in debt if we bought it on credit, represented by accounts payable, a current liability on our balance sheet, or we have invested cash into our inventory, which decreases our cash, a current asset on our balance sheet. Making sales implies that we have, where the sales were on credit, accounts receivable, which is a current asset on our balance sheet, or we have received cash if the sale was for cash. This cash is also a current asset on our balance sheet. We also recall from video number 24 that our net working capital is equal to current assets minus current liabilities. Breaking this down further, we can state that net working capital is equal to cash plus inventory plus accounts receivable minus accounts payable. And with that, we can map out our cash conversion cycle by showing the flows of our cash to our current assets or our current liabilities. We can see that on the current assets side, cash is converted into inventory, where inventory is bought for cash. Inventory is converted into accounts receivable, where sales are on credit. And accounts receivable is converted back into cash when clients settle their accounts. On the current liabilities side, accounts payable increases when goods and services are bought on credit. Accounts payable decreases when accounts are settled for cash. And finally, we consider the key calculations or ratios involved in establishing the length of our cash conversion cycle. We do this by considering each component of our net working capital. We start with inventory. Days of inventory outstanding, in other words, the time it takes to convert cash invested in inventory into a sale, is equal to the average inventory for the period divided by the cost of goods sold for the period multiplied by 365 days. Next, we look at accounts receivable. Days of receivable outstanding, in other words, the time it takes to convert the cash invested in accounts receivable back into cash, is equal to the average receivables for the period divided by the sales for the period multiplied by 365 days. And we end by looking at accounts payable. Days of payables outstanding, in other words, the number of days it takes our business to use its cash to settle its debts, is equal to the average payables for the period divided by the purchases for the period multiplied by 365 days. Days of inventory outstanding plus days of receivables outstanding minus days of payables outstanding is equal to the cash conversion cycle. In order to shorten this cycle, we should minimize days of inventory outstanding by making sales as quick as possible, minimize days of receivables outstanding by encouraging settlement of accounts by customers as quick as possible, maximize days of payables outstanding by negotiating longer credit terms.
In this video, we were introduced to the cash conversion cycle. We considered the relationship between our income statement and our balance sheet, and specifically on our current assets and current liabilities making up our net working capital. We learned that in relation to our net working capital, the following situations exist. Cash outflows occur when we are investing in inventory, when we are investing in accounts receivable, or when we are settling our accounts payable. And cash inflows occur when our customers are settling the accounts receivable. We mapped out our cash conversion cycle and formulated the time it takes to convert the cash invested in our net working capital back into cash. We learned formulas to calculate the days of inventory outstanding, the days of accounts receivable outstanding, and the days of accounts payable outstanding. And we deduced that the cash conversion cycle in days is equal to the days of inventory outstanding plus the days of accounts receivable outstanding minus the days of accounts payable outstanding. And with that, the cash conversion cycle gives us a deeper insight into the operating cash flows of our organization.
If you enjoyed this content, please like the video, subscribe to our channel, and click on the notification bell. It helps us grow the channel and bring more content to small and medium business owners and managers.
Also, be sure to check the description below for any related product affiliate links. And finally, please comment on the video or click on our community tab to further interactions and updates.